Hey guys, today we're going to be covering something called immunization. I'll talk about exactly what it means and I'll also go over a few example questions. Starting off, immunization is just a strategy to minimize the effect that changes in interest rate has on a bank's equity value. And you can see the formula for immunization below. So basically all it is change in equity equals minus duration of assets minus duration of liabilities times K, where K equals liabilities over assets, times total asset value times change in interest rate over 1 plus interest rate. So it's a pretty straightforward formula so far. But in the same formula, you also need to recognize what's called the leverage adjusted duration gap, or just duration gap in short, which is the duration of the assets minus duration of the liabilities times K, and that's highlighted in blue. You also need to know that if the question asks you to calculate the relative change in interest rate, that's simply just equal to delta R over 1 plus R. The duration gap is important because banks generally want to manage their interest rate risk by minimizing change in equity, and one way to do this is they need to also minimize that duration gap by making it equal to zero, or at least making it as close to zero as possible. And that's what we call immunization. So remember, all immunization means is to minimize the change in equity, which can be done by also minimizing the duration gap. Of course, there are other ways to minimize change in equity, which you can probably see from just the formula, but the main way we're going to be covering right now is by minimizing the duration gap. Alright, so let's go over this question. This question does have quite a few parts to it. It's got 5 parts, but we'll take it slowly. So, a bank has assets of $1 million invested in a 30-year, 10% semi-annual coupon treasury bond selling at par. The duration of this bond is 9.94 years. The assets are financed with equity and a $900,000 2-year, 7.25% semi-annual coupon capital note selling at par. Part A. What is the leverage-adjusted duration gap of the bank? Now this question may seem a bit overwhelming at first since we've been given so much information, but let's just try extract the relevant information we need for Part A. So remember the duration gap is calculated by duration of assets minus duration of liabilities times total liability value over total asset value. And the question already gives us most of this information. So we already know that the bank has assets of $1 million invested in a bond. So straight away, we can just go A equals $1 million. The question also says that these assets are financed with a $900,000 capital note. So in other words, the bank has borrowed this note to fund the bond which they invested in. So that means this note is a liability for the bank. So we also know L equals $900,000. And the question tells us that the duration of the bond is 9.94 years. So we know DA equals 9.94. The only thing that we don't know is the duration of the liabilities, or the duration of the capital note. So now we need to find the note's duration using the Macaulay duration formula that we learned about in the last video. So I'll quickly write down the formula for duration in case you can't remember it. Sorry, it's a little bit small, but there you go, that's the duration formula. So all we need is to find these variables inside the formula. Let's start off with the note price. So P. The question actually tells us that the note is selling at par at the very end. So we know that the price of the note is the same as its face value of $900,000. So we can immediately just go P equals $900,000. We can also work out the coupon payment C, which is just the face value times coupon rate. However, the note consists of semi-annual coupon payments, so we need to divide the coupon rate by 2 when doing this calculation. So C equals face value, which is $900,000 times, and here we don't just times by 7.25%, we times by 7.25% over 2, since we're dealing with semi-annual coupon payments. And this will give you $32,625. R is obviously just 7.25%, but since we're working with semi-annual coupon payments again, the semi-annual rate will be 7.25% divided by 2, which is 3.625%.
Okay, now we have enough information to find out duration for liabilities. So duration equals 2. One quick thing I'm going to do here just to save time, I'm going to factor the 1 over p out. So 1 over 900,000, I'm just going to pull outside the brackets. That way we don't have to rewrite it every time for each time period. So that's out of the way. Now let's just go to our first period. So again, coupon payment on the top, so 32,625. On the bottom we have 1 plus yield. One thing I forgot to mention, since the note's selling at par, we know that the yield is the same as our coupon rate straight away. So this will just still be 1 plus 3.625%. Now this is where the tricky part comes. This is going to be to the power of 1 since it's still the first coupon payment. But we don't times it by 1, we times it by 0.5 instead. Now this is a little bit confusing because we have a t here and we have a t here, though they aren't actually the same t's. This t here refers to the time period within the present value of the coupon payment. So you can treat the first part, this fraction, as just calculating the present value of that coupon payment. Whereas this t out here, this t is actually, it's in terms of years. So since this question is dealing with semi-annual coupon payments, this is actually only a half of the year so far. It's not the full year, so we need to times it by 0.5 instead. This is probably going to be the trickiest part of this question. Hopefully it'll make more sense as we do more of this. So let's go to our second coupon payment. Again, now it's pretty much going to be the same thing from here on. So coupon payment over 1 plus yield. Now this is going to be to the power of 2, and we're going to times it by 1 here. And this is simply 2 because we've already accounted for the semi-annual coupon rate. Oh, sorry, the semi-annual yield. And over here, it's been a full year, so we times it by 1. And now just keep adding. We have 2 more time periods to go. We have 4 time periods in total because we have 2 years, or also 4 semi-annual periods. So this is still the same. Now this is to the power of 3, this is times 1.5. Okay, last period. We need to remember to add face value onto our coupon payment, so plus $900,000. And we still have 1 plus yield. Whoops, I just realized I forgot the percentages here. My bad. This is to the power of 4 times 2. Okay, and doing this massive calculation, we should get 1.8975 years. Now the duration calculations usually are quite a pain to do since they're very long, but in an exam you probably won't get a question this long, to be honest, so you probably won't be asked to find the duration of something with 4 time periods like this. This is probably one of, if not the hardest type of questions you'll get on duration. So if you think you're going to run out of time during an exam doing this, don't worry, because you're probably not going to get it during an exam. This is just to show you what a complicated type of question might look like. And I just realized I'm missing a bracket here as well. So now that we've found the duration of the liabilities finally, the question wanted the duration gap. So let's quickly do this. Duration gap is simply just duration of assets minus duration of liabilities times L over A. And we've got our assets, duration of assets already, which is 9.94. We've also got the duration of the liabilities now, so 1.8975 times, we know the total value of liabilities is 900,000. I'm just going to write 900k. And our total asset value is 1 million. So this calculation should give you 8.23225 years. Okay, we're halfway there. Part C. Using the information calculated in parts A and B, what can be said about the desired duration gap for a bank if interest rates are expected to increase or decrease? So first of all, let's not worry about parts A and B. Let's just think about what a bank wants their duration gap to be if they want to completely minimize interest rate risk. So that means if they want change in equity to be equal to 0, then obviously they want their duration gap to also be 0, right? We sort of covered this very early on in the video. If you have D gap equal to 0, then if you're doing the calculation using the formula, then you're basically just doing 0 times whatever, and 0 times 0 times anything is always going to be 0. Now also recall that we got a change in equity of $16,000 in part B, which is obviously good for a bank, right? They've essentially just gained $16,000. And the reason why was because of their duration gap and the change in interest rate. Since they had a positive duration gap of 1.89 years, and the change in interest rate was a negative 20 basis points, therefore they had a positive change in equity value. And you'll know this by remembering these two relationships. So if a bank expects interest rate to decrease, then they should make the duration gap positive for a positive change in equity. And on the other hand, if banks think that the interest rate is going to increase, then they should make the duration gap negative. And that'll also give them a positive change in equity. This is sort of like the repricing gap, which we covered in the repricing model videos, except it's sort of like the opposite relationship. Alright, part D. Verify your answer to part C by calculating the change in the market value of equity, assuming that the relative change in all market interest rates is an increase of 30 basis points. Okay, so this is basically the exact same as part B, but instead of the relative change in interest rate going down by 20 basis points, it's going up by 30 basis points instead. So let's just do the same calculation. Change in equity is equal to, and the duration gap's still the same, which is 8.23225. Our total asset value hasn't changed either, it's still 1 million. Now instead of doing times minus 0.002, we're going to do times 0.003 for 30 basis points. And this should give you minus $24,696.75. So notice how the interest rate has increased instead. And because the bank has a positive duration gap along with a positive change in interest rate, that's going to lead to a decrease in equity value. Okay, last part. What the duration of the assets need to be to immunize the equity from changes in market interest rates. So essentially for this question, we're trying to find the duration of assets, the value for the duration of assets if we were to make the change in equity equal to 0. So to immunize equity from change in interest rate, remember that you essentially want to have duration gap equal to 0. So D gap equal to 0. And what is D gap again? D gap is just your duration of assets minus duration of liabilities times total liability value over total asset value. And we want to make this equal to 0. Now we can just rearrange this equation in terms of duration of assets. So we have duration of assets equals duration of liabilities times L over A. And we already have these values. So duration of liabilities is still 1.89775 times 900,000 over 1 million. And this should give you 1.70775 years. Now this is what immunization essentially is. You're trying to find the optimal values for variables such as duration, such that the change in equity will equal to 0. In other words, you're trying to eliminate any interest rate risk so that your equity value stays the exact same and doesn't change.